Over the past months, we've been saying a recession could be very close with a potential effect on the stock market, meaning major correction or longer bear market, essentially breaking the current spectacular rally. Right now, this idea of incoming recession is supported by the jobs data in the US economy. This chart shows a year-over-year change in employment, basically showing that in August 2025, there was a sharp drop in full employment, less people getting a job. A full-time employment is an absolutely necessary factor if the economy is supposed to perform well. No economic growth is possible if addition of new jobs is declining. Around 70% of the US GDP comes from consumption, but consumption isn't possible without income, and income comes from employment. People getting paid by their employer means they can spend more, driving corporate earnings upwards. This is precisely the reason why full-time employed people are the backbone of expansions and contractions. When full-time jobs grow steadily, households feel secure and continue spending. When they weaken, consumption slows and the cycle risks turning. As you see, every major recession historically was preceded by a drop in employment. The current drop could be a strong trigger for a massive bear market. If we really want to know what's going on and what the effect it will have on the stock market, we need to realize that historically the movements of S&P 500 have been influenced by few major variables. In the long run, the most important factor for the US economy and for the performance of American firms is how easily they can breathe, meaning how tight or loose financial conditions are. Ideally, there'd be low inflation and low interest rates. This is what's called a Goldilocks scenario, and it was really only seen in the 1990s. By contrast, the 1970s brought stagflation, a mix of painfully high inflation and weak growth. This is also the reason why long-term interest rates like the 10-year Treasury yields have such a massive influence on the performance of equities. As you see, over the past few years, we see nearly every major movement of the stock market was accompanied by a converse movement in the yields of the Treasury bonds. Such behavior is due to the fact that higher yields pressure economic growth. It's an extremely important factor. When 10-year Treasury yields rise, stocks often fall because borrowing gets more expensive and investors shift towards safer bonds. When yields drop, the opposite happens. Also, it is important to mention that when yields rise, it naturally makes them more appealing as investors earn higher fixed returns relative to their risk. Both consumers and producers respond to these economic actions. A key indicator of consumer behavior is the University of Michigan's Consumer Sentiment Index, which reflects how consumers feel. At the moment, consumers are spending very little. In fact, the current level of consumption and the hesitation to increase it is comparable to what we saw during the 2008 financial crisis. This is far from an optimistic sign. To understand how producers in the economy are behaving, a very powerful indicator is the sales of heavy trucks in the United States. These vehicles are a critical part of the production chain, so when businesses are confident about future demand, they invest in expanding their truck fleets. As a result, higher truck sales signal greater optimism among producers, while lower sales reflect caution or reduced confidence. When we place the data on truck sales alongside consumer sentiment charts, we see a striking correlation, showing how closely the outlook of producers and consumers can move together. The correlation becomes even stronger when we shift the consumer sentiment chart forward by about 4 months. This adjustment shows that, in many historical instances, consumers, and by extension consumption, have taken the first step, with producers reacting afterward. As we mentioned earlier, when discussing unemployment, consumption often leads the cycle, setting the direction before production follows. Furthermore, when we compare truck sales to the stock market, we see another pattern. Declines in truck sales have almost always been followed within a year by a drop in the S&P 500. This suggests that truck sales can serve as an early warning signal, not only for producer sentiment but also for broader market movements. That is indeed an extremely powerful indicator. We rarely hear of the truck sales indicator on major news outlets, and it's not something that obvious at first glance. The behavior of the curve is quite monotonic, and usually when truck sales go down, it doesn't go up that easily. It is a cyclical indicator. Investors who are doing smart moves throughout all parts of the cycle are well aware of this relationship. An economy can only grow if the conditions are positive. To outline what would be perfect now, it would be the rate cuts continuing, full employment, corporate earnings growing, and somehow in all of this inflation staying low. This is precisely why we mentioned earlier those yields on 10-year Treasury bonds. Since markets and the economy are closely linked, it's important to note that while the Fed directly controls short-term rates through the federal funds rate, Treasury yields are determined by market forces. Still, expectations about Fed policy have a strong influence on those yields. The Fed has recently lowered the effective federal funds rate to 4%, a 25 basis point cut, and markets anticipate more cuts in the coming months. This clearly eases financial conditions and creates a better environment for stocks performance. Based on this, it would make sense to expect equities to rise. But it's important to remember that the relationship isn't always that straightforward. In the beginning of this video, we mentioned the growth is slowing down, given the number of jobs in economy. Corporations are not doing all that well. And historically, a rate cut was seen during times when the economic conditions actually needed more free environment. In 2008, we've seen a rate cut just before the recession. Right after that, the rates dropped to zero. We've also seen a rate cut during the early 2000s before the recession back then. So rates cut are usually confirming what we already said in the beginning of this video, and that is the economy isn't performing that good, and that on the other hand, could harm the markets. Therefore, right now, everything depends on whether the economy can now pick up again, creating new jobs, boosting production, and driving stronger consumer spending. If the drop would continue, we'd see it hit the markets too. None of the information provided should be considered financial advice or an investment recommendation. Our goal is serving you the best educational content. Thanks for watching. This is Glenneus.